Great. So let's get started.
Yes, we are.
So, is everyone ready for tax season? I want to hear from you in the comments for those of you that are not driving, if you can share answer a quick question. When do you normally start planning for tax season? And just give me like one word, two words, so I can get an idea of how we're doing here with tax planning. Eric, let's see what we have here. October. Thank you, Jurish. January 28th for tax planning. All right. And I hope that those of you that are working on your tax planning, you're actually working on your 2025 tax year. Because as you know, 2024 is over. So it's really important that we start planning today for this next tax year, and that we understand what we're doing and how much money we're planning to make, or our projections, so we can plan ahead and put those measures in place to make sure that we are setting ourselves up for success. So that's number one. Thank you for those who are proactive at getting started. All right, so Engineer Tax Services is the firm I represent. As you already know, let's see, first slide, is it working? There we go. Got the structure there. I am Sharina Padilla, and I've been working for the past 14 years side by side with our CEO and founder, Julio Gonzalez, at the forefront of specialty tax incentives here at Engineer Tax Services. We are a national leading provider of innovative tax solutions, and we work closely with CPAs, real estate investors, business owners, and family offices. I would say that one of the areas where I add the most value is being a master connector. I always try to bridge the gap between top tier CPAs, CFOs, advisors, and bring our ETS expertise into the table. My role is always to elevate and empower all the professionals with strategies that can elevate their tax planning techniques, optimize audits, and deliver extraordinary results for yourself and those that are part of your community. I'm really honored to be here with Eric. Thank you for the opportunity and making the space for me to come in and do what I do best, which is raise awareness. My mission is it's always to provide these type of solutions that drive real value, save money, and build lasting success. So I love it when I have the opportunity to collaborate with communities like-minded, where everyone is here to learn and grow together. So it's always just a win-win for everyone, and hopefully I can elevate your practices and help you achieve your goals. So by the end of this session, I want you to have informed access at your fingertips so you can make the best decisions and scale your portfolios, hopefully. My track record, it's been proven. I have managed over 20,000 projects across different industries and markets nationwide, and saved over $3 billion reinvested into businesses and growth opportunities for many communities. And with my national reach, I'm always enabling tax optimization at scale for professionals everywhere. So hopefully you'll find this presentation helpful, and you're able to learn a few tips that you can apply to your businesses. Okay. Engineer Tax Services was founded in 2001, so we have over 2 decades strong of great record and reputation. Our goal has always been to help and be a resource to all small to mid-sized businesses, right? So we want to bring the best tax strategies and the knowledge from the tax code that sometimes we find daunting and it's not available for the normal business owner because we are all busy trying to run our businesses and figure out how we're gonna deal with day-to-day operations and challenges that we deal with. So the same opportunities that large corporations have are available to everyone. So I want to make sure that if there's one takeaway that you're going to get from this presentation is that at the end of the day, we all win if we can bring each other up with us, right? So those benefits that large corporations have benefited from for years are pretty much accessible, and that's what I want to raise awareness on and make sure that we can create that tax equality that we all deserve for communities, for our families, and for our employees, right? We are a national licensed engineering firm, also certified as minority owned. The core of our business is going to be engineering studies for tax deduction purposes, focusing on education and also awareness. The company has evolved over the years through acquisitions. We now operate under our umbrella company called the Engineered Advisory. So that's where we bring a higher level of expertise outside of the engineering industry and help CPA firms and family offices have access to other resources that normally wouldn't be available to them. So we come in as a collaborative partner, always trying to bring the best of what's available to the table. There's 3 companies that we own and that are part of the growth of Engineered Tax Services and how we've been able to scale over the years. One's the Growth Partnership, Inside Public Accounting, Digital Magazine, and also we have a CRM called Able. And all of these, again, are to assist CPA firms. So when I hear from a specific client or business owner, hey, our CPA handles our taxes, that is completely true. But our services go beyond traditional tax preparation. So we want to act as an extension of your team and provide that highly technical solution that can uncover the hidden opportunities that most standard approaches would normally miss. All right. So that's the value proposition and what you would get working with a trusted advisor like me. So we are going to be covering these advanced tax strategies, make sure that everyone has the information at their fingertips and that we're able to walk through each of these steps together. As you may have heard of before, real estate is the best investment for wealth preservation when the tax incentives are applied. So that's a true statement, and I'm sure the like-minded community would agree with that. That's what we are all trying to promote here and make sure that we can use them wisely. So today I'm going to go over cost segregation, repairs and maintenance reviews, partial asset disposition, bonus depreciation, energy tax incentives, and then state and local incentives. Believe it or not, many organizations have disregarded completely the state and local incentives. So if you're a business owner and you're trying to scale your portfolio or a residential rental business, there may be state and local incentives that would apply to you. And those may be presented as incentives for those who are creating new jobs, any incentives for people investing in rural zones, opportunity zones, a qualified opportunity zone, those are a big one. Believe it or not, there's 8,700 opportunity zones amongst the 50 United States, and US territories. So there's a lot of opportunities out there for those that are interested or want to expand their portfolio in real estate. So let's get started. Cost segregation, I'm sure some of you may have already be familiar with this term. We know that this is a cornerstone strategy for real estate investors. And if you go back into your last tax return and look at your depreciation schedules, you should be able to identify pretty quickly whether or not you have been taking advantage of this benefit. Normally, properties are booked using a straight line depreciation method of 27.5 years for residential rentals or 39 years for commercial properties. So if you see your property, it will be labeled as building or the address of your property, and you will clearly see what depreciation method your accountant is currently using. One of the things to keep in mind is that accountants do not have the resources or the capacity at times, especially now during tax season, to have an engineering team in-house that can produce these type of reports. So the IRS is not going to come knocking on your door saying, hey, by the way, you may be saving money on taxes, but you didn't choose to, right? So they're going to take whatever you are submitting and reporting as that will create more tax bills for you, right? So it's very important that you understand how your properties are being booked, whether it's your current properties that you've already placed into service or future properties coming ahead. The most proactive CPA will make a mention whether or not your property may be a good fit for accelerated depreciation benefits, but it is known in my industry that most don't bring this up, or they just think that maybe wouldn't be beneficial, or they don't really have the time or the energy to go, search for a provider that can bring a level of expertise that's not going to raise any flags with the IRS. So at the end of the day, we want to be compliant and we don't want to be creating issues for ourselves. So whether you own residential properties or commercial properties, cost segregation will allow you to improve your cash flow. It will enhance your return on the investment and also give you the flexibility to grow your portfolio. What's accelerated depreciation? What that means is that imagine you having a full pie of pizza and you would be allowed to take 2 or 3 slices of that pie and eat it all at once in one sitting. That would be your accelerated depreciation method, right? So would you prefer to eat those 3 slices in one day, or would you prefer to eat them over a period of 3 weeks, 1 slice per week? So if that makes sense, if that doesn't make sense, let me know. But pretty much we would want to have all of our slices in one sitting rather than wait for a long period of time. We also want to optimize our annual write-offs. We want to be able to record our repairs and maintenance or routine maintenance routines. And then by keeping track of all those individual assets, you'll be able to record any demolished or retired components of your building. That will reduce your recapture upon sale. And then lastly, we have bonus depreciation, and I'll talk a little more about bonus on the following slides. I have an example to share, which is a multifamily residential developer that created or developed a facility with multi-use buildings where they had retail and apartments on top, and then they had a number of townhouses in the rest of the property. He was able to obtain $1.2 million in deductions from that project alone. And that allowed him to pay for the down payment of the next property he acquired and developed. So don't be afraid to ask questions and run the numbers. At the end of the day, that's what we're here for. All we can do is have the information in front of you so you can make a decision of whether or not this would be a viable project for you. And definitely accelerated depreciation, it's going to help you get there faster. So just so you have an idea of what the process is for us, I'm gonna share a couple of details on how we work differently and why you do want to consider going in and having this type of study created for your investment properties. You all know what's going on in California. It felt so good last week when I got a couple calls from my clients saying, hey, can you please resend the report you guys did for me 3 years ago? My house burned down, and now I'm getting ready to start putting everything together for my insurance claim. The engineering reports and the detail that we put into each project, it's subpar. It's just amazing. So we want to make sure that you understand that settling for any do-it-yourself or square footage allocation type of study may not be in your best interest, because that will result in reduced tax savings, and it will also may end up putting you under an audit, and we don't want that. So all of our reports are completely done by an engineer, qualified engineer. The site visits, we do visit every single property and take all the information to make sure that you have a thorough audit-proof report. And it's all delivered with that unmatched detail and precision to safeguard your business. So having that space-by-space breakdown to capture every single deduction will ensure that every dollar you claim, you're entitled to. So always do your due diligence and make sure that you're working with experts that are going to be able to help you identify all of the items that you are entitled to receive now, and also the potential benefits that you may be getting in the future. Make sure that you have a trusted advisor that's also working with your CPA, with your attorney, and that you have a team put in place to help you make the right decisions, and that they understand where you are now and what your goals are. So everyone's working in a synchronized manner. So I will share a little bit about a video so you guys can see some more visuals and a more detailed explanation. So let me play here.
The Next Generation Cost Segregation Study. Cost segregation is a tax strategy that has been used successfully for years to help property owners lower their tax liability by accelerating the depreciation on fixed assets, like an office building, through properly identifying every component of that building as preferred by the IRS. But is there more to be found? Engineered tax services like Next Generation Cost Segregation Study looks beyond accelerated assets and into separate building systems, tax incentives for energy efficiency, disposition of items no longer in use, charitable deductions of materials eligible for donation, accounting for repair and maintenance costs, and even reducing liability insurance premiums with a detailed engineering appraisal. With cost segregation, instead of a $15 million property having a tax write-off of only $384,000 per year, the tax write-off could be nearly $1.2 million per year. Think of an office building like a tall box that holds many individual blocks. If you pull out the separate building systems, like taking a block off our building, those components can help property owners increase their annual write-offs. Building systems include fire protection and gas distribution, the elevators or escalators, the lighting, electrical, and HVAC systems, just to name a few. And other assets like landscaping, flooring, cabinetry, and special lighting and electrical would qualify for shorter depreciation than the building itself. Having this detail in one report creates a valuable tool for property owners to ensure IRS compliance, optimum depreciation, and additional write-offs each and every year. Real estate can be the best investment for wealth preservation when tax rules are applied.
Right. So that was just a summary of the details that we just covered. I am now going to move on into a case study for an actual property that we studied recently. This is an Airbnb type of business setup. The client purchased this property for a little under $1 million. The property is located in California, so the land allocations are usually higher. Let me know in the comments if you guys are familiar with land allocations, and I'll be happy to expand on that a little further. So pretty much this property, they were able to reclassify 25.59% of that purchase price into their 5-year bucket, and another 17.3% under the 15-year bucket. And I'll explain a little bit what each of those mean. So the itemized version of the study is going to break out everything that is not structural and that it's not part of the actual building that surrounds the building. So that would be anything from your driveway. You see that asphalt driveway. They have landscaping. In this picture, you can't see it, but this property also has an outdoor swimming pool and spa, a kitchen, outdoor kitchen, and fire pit. Then they have some artificial turf. So all of those items were able to get qualified, quantified, and reclassified to their useful life, which was the 15-year bucket that we see here. And then on the 5-year section, they had high-end appliances, custom cabinetry and countertops, and specialty lighting in some of the main rooms. And they also had a security system and audiovisual systems. So all of these items were able to come in and get them almost 40 to 43% in benefits that they were able to take into it, advantage in their tax return. So I always say when I make any type of estimate that anywhere between 20 to 30% reclassification is a conservative amount. And as you can see, we always strive to identify the components that are going to help us or yield a better benefit. And the way we do it is using a conditional factor for all of these items to make sure that we are maximizing but still staying within IRS guidelines. Let's see. Any comments on the land value, Eric? Not able to see the chat.
Yeah, I don't think any comments on the land value.
Perfect. Perfect. And just briefly, there's land value allocations that need to be made for any property that you purchase. So depending on the state that your property's in, the land values are going to increase or decrease. I always use a rule of thumb of 20% from the purchase price. That number gets deducted because land, it's a non-depreciable item. So if we start with a property that's worth $1 million, we take 20%. Now our building basis that we will be using for our study would be $800,000. So in this case, it was somewhere around that pricing. And since it was California, the land was a little bit higher, probably at 35% in this case. But they did have some great building components that they were able to reclassify. All right, so just to make sure no one's falling asleep, does anyone know what is the status that allows real estate investors to offset their active income in real estate? Anybody in the comments?
I'm not seeing anyone on the comments. Oh, short-term loophole. Oh, can you repeat the question?
Yeah, so what is the status that allows real estate investors to offset active income with real estate losses?
Can I answer?
Yeah,
Is it real estate professional?
correct. The real estate professional status, and we'll go over into that in a little bit. But in this case, for this property, this client was considered a real estate professional. He is a small business owner. His wife manages the properties, and he was able to offset the income that he produced that year with just one property because he fell under that classification. So imagine if you're a high earning individual, whether you're, professional working in tech or attorney or physician, if you're able to combine the power of cost segregation with bonus depreciation and real estate professional status, bring all of this together and keep more money of your hard-earned money in your pocket. So that's the goal, right? So let's keep going, and hopefully we can find some real estate professional statuses in this group that are interested in learning how much money they're leaving on the table.
So there is another question about short term. It says on the average guest stay being less than 7 days, correct?
Correct, that is correct. So the average stay needs to be less than 7 nights. That would be correct. So let's and I'll go into detail in this slide. So we're right in the conversation here. So who is a good fit? So anyone who owns commercial or investment property, whether they're short, midterm, or long-term rentals, those will qualify. And the difference between short and long-term rental, it's obviously the short term, like we said, it's 7 days or less on average. Long-term rental is going to be any property that is leased for 30 days or more. So we'll have to figure out what the classification is for each of the individuals and which category they fall into. So each case will be different just because of all the nuances and details for each client. So anyone that is building or developing a new structure, or anyone that's doing renovations that are $75,000 or higher, we can also do an analysis on those projects. For cost segregation, energy incentives, we have 179D and 45L for commercial and residential real estate that has energy efficient components. So that's an add-on to all the benefits. Anyone that's paying federal income tax and that wants to keep that property longer than a year. So it's very important for anyone that's looking to take advantage of accelerated depreciation. That asset needs to hit your books. In order to do that, it needs to be on your depreciation schedule for at least a year, right? And then we have our real estate professional status. That has some other requirements as the material participation rules, that you have to at least be actively working on the property for 100 hours or more. And that needs to be for you. How do I explain this? 100 hours or more than anyone else in the property. So let's say you have a housekeeper that comes in between cleanings, that person cannot be logging in more hours than you are. So that's always a pitfall that people don't take into consideration just because you're managing the property, but then you cannot have another contractor or employee putting in more hours than you are. So I would always say, like, if you only have one short-term rental, it's gonna be very, very difficult to justify that real estate professional status just because, especially if you have a W-2 income, right? So I would say anything over 3 properties will probably be easier to justify. And then the long-term rentals, they do have to meet different requirements. And then there's the 750 hours per year. They may or may not have a property manager depending on how many properties they are managing. And that comes out to an average of like 14 hours per week if they want to qualify for that real estate professional status. So if you do have W-2 income, then and hire a property manager, you have to find a way to prove that you're doing more hours on your real estate business than on your actual job. So it just goes back to the same thing. But there's still other options for those who don't qualify for real estate professional status. We have the modified adjusted gross income allowances, or MAGI. That one allows you $25,000 in allowances for those who actively manage their properties but don't qualify for rent status. And then we have other great options on how to manage the losses that you are accumulating if you are a passive investor through grouping elections and other options. And I'm happy to answer those questions if anyone needs additional guidance on those items. All right, so moving on to bonus depreciation. This, I always call it the elephant on the room because everyone wants to know what's going to happen with bonus depreciation. As we know, in 2025, any properties that you are acquiring or improvements that you're placing into service this year, you will be allowed to take 40% of bonus depreciation. Next year, it will be 20%, and then it will sunset in 2027. The latest information that we've received from the Hill is that if the current bill doesn't get approved, they're still going to try to resubmit it and find a way to get a percentage of that bonus depreciation be placed in there as a permanent rule. And it could be anything, anywhere between 50 and 75%. So even if we make it to 75% and it's permanent, that's going to be a huge incentive for those that are really looking to promote affordable housing and create more jobs in our community. So I'm crossing my fingers and hoping that that happens sooner rather than later. All right. Dispositions. So we have talked about the new acquisitions, the improvements, but dispositions fall right in between those two items. So by properly documenting all the items that came with your property at the time of purchase, you will now have the ability to keep track of anything that comes off. So with that baseline study that you will create with your first cost segregation study, you will get a full fixed asset report that will allow you to take additional write-offs in years to come. So you'll have your immediate benefit, but then in the future, if you do end up putting away or demolishing or pretty much abandoning a portion of your asset, you are allowed to get that as an additional write-off. So we do have a disposition calculator on our website. I have the link here. I'll share it with you guys after the presentation, and I'll show you how that works. but it's pretty interesting. And this could work for window replacements, re-roofs, and even like appliances, where you'll plug in the information of when the original component was placed into service and when it was replaced, and it will give you a breakdown. And this is completely free, no obligation, of how much you can estimate that has been depreciated using that straight line method, and what that remaining basis is that now you can dispose of, and then add the new component that you're putting in as an improvement. So it's a great tool that it's at your it's accessible for your use. So I hope you all get to use it at some point in the near future. All right, so real estate professional status, we kind of like talked about this. I just want to reiterate the importance of having proper documentation. With the IRS, it's all about the documentation, what records you keep. So I always recommend to make sure that any single event, task, any management activity that you are doing for your real estate business, that gets logged, whether it's on a spreadsheet or on a project management software, or even on your calendars. It's so important, and that will come handy if anyone ever asks you, hey, what's happening with your property? You may not qualify for real estate professional status, and your accountant will also have peace of mind if you're able to provide them with those records. So make sure that you keep every single receipt and log every single activity that you're doing, and that you can tally that up at the end of the year. There are many applications and platforms that have been developed to assist in the collection of these items. And one of the other services that we provide is research and development tax credits. So for those of you that are innovative and that are looking to enhance your processes or create a new application, perhaps, that would be something that it would be worth looking into, to make sure that you are taking advantage of additional incentives that are provided for those who are hiring software developers here in the United States. You could potentially get a reimbursement for the wages or the expenses incurred for these type of services. All right, so the next slide here is talking about passive investing. Again, I just want to like dive a little deeper and go into, some of the challenges that we often face with being a passive investor. There's nothing wrong with being a passive investor. Like, in my opinion, that's the steady road to financial freedom. Always think about the time value of money and opportunity costs. Like $100,000 in losses today could translate into $250,000 10 years from now if invested in the right vehicles. So always think about that, and instead of like saying, well, maybe this is not for me, right? So run the numbers and have a strategy and a plan in place, and believe me, it will take you places for sure. The one item that I want to emphasize on is the grouping elections. If you have multiple properties, you can combine all of those activities to maximize your deductions, even if you are a passive investor. And then obviously with cost segregation, you can speed up that benefit. And then lastly, there's other strategies. If you want to avoid recapture, you can use these advanced tax tools like opportunity zone, qualified opportunity zone funds. There's 1031 exchanges and a few others that you should keep into consideration if you're thinking of what's next after you have managed your properties for some years. I do have some clients that are already on the back end of the process, they've invested for many years. Now they do want to get rid of some properties and figure out what's the next chapter in their life because they do enjoy the benefits of that passive income. And I'll share a couple more options on that. So if you're facing capital gains taxes, you had a huge liquidity event, you are worried that the IRS is going to take a significant portion of your profits, or if you're concerned about managing new properties after a 1031 exchange, there are options for you. So you can reinvest that money into a vehicle like the Delaware Statutory Trust, and those will allow you to take advantage of the same benefits of having one property, but in this case, you are now investing into different funds or larger properties that will yield similar benefits to like accelerated depreciation and also give you that passive income that you desire. So always look for the informational sessions, constantly hosting some on my own or joining teams like the like-minded, and then you will figure out what would be the best for you. Some people really don't like 1031 exchanges, and we've kind of like used this term, made up term, called the lazy 1031 for those that don't want to deal with that 45-day identification period and the 180 days. So the idea behind that is that the cost segregation analysis can be used in lieu of that 1031 exchange. And the way you would do it is by selling your property and buying a new one within the same tax year. And then you'll avoid all the requirements that come into play with the 1031 exchange. The gains that you get from one property, you just immediately reinvest them in the next one. You'll complete a cost segregation study on the new property and offset all of those tax liabilities. But it only works if you do it in the same year. So just keep that in mind. All right, so I would like to know if you guys are ready to uncover the hidden tax savings and any of your real estate investments. I will be here and happy to answer any questions that you guys may have for me.
All right. Well, thank you. Thank you so much. That was amazing. I really, really appreciate that. Thank you. You know, there is actually a Rory has a question. And I think let's get into that question. Did you see that on your end, Sharina? Or
Let's see.
all right, so he says, can you do a cost seg on a property if it's already taken the straight line depreciation the first year of operation?
Yeah, that's a great question. Thank you, Rory. The accelerated depreciation can be taken at any time, even if you bought a property 5 years ago. So as long as there's still a depreciable basis in the books, we can go ahead and complete the cost segregation study. And the one important thing to think about is that you don't even need to amend your tax return. So, you know, she said the property was bought a year ago, so she may have already filed her 2023 return. So now all she has to do is with her next tax filing event, she'll file Form 3115, and that will include the adjustment and the catch up on the missed depreciation that she didn't take in the first year.
Okay. Let's see. Did you get that, Rory? All right, we have another question that came in from Sam. What is the max? And by the way, if you, I don't know if you guys can or not, you're more than welcome to unmute yourself and ask as well. This is open forum, open source, so feel free to do that. But what is the max W-2 income to deduct 25K losses to offset active income?
Would be $100,000. So if it goes over $100,000, there's a ratio that comes into play, and then anyone over $150,000 has a different amount. But as long as we keep it under 100, you should be allowed that $25,000 allowance.
Awesome.
Yeah, I'm just going to jump on. Just to get a clarifying question, if that's all right. So you can still, if you make over 150,000 in your W-2 job, you can still write off losses as long as it stays less than 7 days. It's just at a different rate. Is that what you're saying?
Um,
Or you can't write them off at all?
you have a full-time job and you also have a real estate investment. And are you saying you don't qualify for real estate professional status? Because that would be different than the modified adjusted income allowance.
I don't know how it would qualify. How do you? I guess I think I had to step away for a couple of minutes. But from my understanding, to be a real estate professional, it has to be like what you do full time, right? I mean, like that's your main source of income.
Correct. And if I may ask, what's your line of business where you operate?
So I have a full time. I'm a sales leader. I have a full time W-2 job, and then a short term, couple of short term real estate properties on the side.
Okay. And you are managing them. You don't have a property manager.
Yeah, I am
Yeah.
managing it. Yeah.
Yeah, there may be an option there for you to log and document those items. As long as you're not spending more time on your full job, it would be allowed. So we'll just have to look at all the different nuances. So if you have if you work 40 hours in your current job, maybe it will be a little bit harder because like your material participation will be about 14 hours a week. So that 40-hour job, it's going to exceed that amount. But if there's a way that you can document other activities, not necessarily to the current properties that you own, maybe you are sourcing other properties and you are attending meetings like this one to learn more to add on to your real estate business, that would add up. So it's just a matter of trying to look at the guidelines and your specific situation to make sure it's documented properly moving forward.
So would it need to be more than, like, if I work 40 hours a week, it would need to be 41 towards real estate, is what you're saying?
Correct.
Okay. Okay.
But at the end of the day, there's always something that you can do with the losses that you're accumulating. So let's say, for example, and I had this happen to one of my clients recently, they decided to sell two of their properties just because the market was a seller's market, right? They wanted to capitalize on that and move on to another property. And they had losses that they had accumulated just due to operating expenses, and the property was vacant for a few months or whatnot during the pandemic. And now, now they're back to having positive cash flow. But all of those losses that they accumulated with the cost segregation study, with their operating expenses, at the moment that they sold those properties, that line that divides active versus passive completely goes away. It jumps the line, and now that property can offset your W-2 income that tax year when you sell it, if you have enough losses booked in there. So it's like harvesting your losses.
They just carry them to the future for when you sell?
Correct. And that's a strategy that people apply.
So you would just have to pay less capital gains tax when you sell? Okay.
Pretty much, yeah. And then obviously with the right recording methods of any disposed items, like you will be able to minimize that recapture as well. And in this case, it was very minimal. They didn't have to pay much. So So that's definitely a strategy to consider in the future. Like, let's say for your sales job, you plan to have a big 2025, maybe you can do something like that where you harvest your losses right off your W-2 income.
Okay, that's helpful. Thank you.
Yeah, we can have an individual call, Sam, and we can explore other options that may be beneficial for you for sure.
Yeah, that would be great.
Excellent.
Thank you, Sam. Appreciate it.
Let's see. Anybody else here?
Yeah,
Garish?
yeah. If anyone,
The recording will be shared. Yes, that is
Okay.
correct.
Thank you. Thank you. That's all. Thank you.
You're welcome. Nick.
Hi, how are you? Thank you so much. I'm located in Florida and I just started my business in 2024, being the first year in business. Is there any sort of first year opportunities that I can take advantage of on a federal level for tax deductions? Again, being, the first year in operating and startup.
It depends the area where you're located and the industry that you're in. Would you mind sharing a little bit more about your startup business?
Yeah, sure. It's in Central Florida near the Orlando area, and it's a single family home that is used for short-term rental on sites like Airbnb, VRBO.
Yeah, I'm not sure as far as like single family homes, like actual federal incentives, but definitely cost segregation, if you have not done that, that would definitely help you.
Right. Okay.
Yeah. So it's pretty straightforward with my process. Like all I would need is your address, the date you close, and how much you paid for the property, and I can give you a non-obligation benefit analysis um for that property, and happy to collaborate further to see if that would be something that would benefit you.
Thank you so much.
You're welcome. Thanks, Nick, for participating and for being here.
Sheree. Oh, sorry. I know that you have it up on the screen, but would you mind sharing your information on the chat, and then how can people also reach out to you and yeah, ask you more questions?
Yeah, well, this is my direct number and email. You can feel free to schedule a consultation with me. My fees are based on success. So if I'm not able to put money back in your pocket, there won't be any fees associated with my service. So it would be great to be able to partner with you guys and show you what I've learned over the past 14 years.
Awesome. Amazing. And I know it's 8 o'clock, but right before we leave here, any last minute questions, concerns, anything you want to ask Sharina?
I have another question. Sorry. I have a duplex that well, it's a house that was split into two units. And I bought it as a primary. I moved out, and the property is not in the LLC that I have. And so from my understanding, I really shouldn't, maybe we should just I could just actually have a conversation with you directly, Sharina. That's probably best.
No, and that's a very good scenario. So for those of you who have had primary homes turn into rentals, there's some other items that come into play when it comes to the place and service date. So we'll go over that offline, Sam, and talk about when did you start producing revenues, and then we can take it from there. Right, we have Carlos and Debbie. Any questions? Feedback is also appreciated. So if there's anything that you guys would like to learn more, let us know. Eric. It's great at bringing the best and latest information into the community. So anything that we can do to better serve you, feel free to share.
Awesome. Thank you so much, Trina. Again, thank you for
No
spending
problem.
spending a full hour with us. I know it's hard to get away sometimes, but sharing quality information is what we're all about here, kind of like what you said. We bring the best around town and around the country to share what they have and what they can offer. So I appreciate that. I also just real quick, if no one has seen, so if you go to likemindedpro.com, we have this webinar will be on inside the webinar section, right? So if you go here and you roll down, you'll see it here, and you can also review it and watch it whenever you want on our YouTube channel. Also, if you have not yet seen anything here, we do have a summit coming up in Orlando. That should be the end of March, if not April. And then on top of that, we just rolled out a new deal center. It's a little bit different, kind of interesting. But if anyone has any deals that they want to post, they can post on here. We get over 10,000 views a month. So we just want people to post what they have. If they have for sale by owner, if they're wholesalers, if they actually, if they're realtors, whatever they have, feel free to post on there. So yeah, I appreciate everyone coming on today. Again, I know it's a little difficult to step away from life for a little bit more of an hour, but if you have any questions, concerns, feel free to reach out to us. My name's Eric Greenstein, the founder of Like Minded. Sharina, thank you again, and we really appreciate it.
Thank you, everyone. Have a great day.
Bye,
Thank you.
guys.
Bye-bye.